Welcome to the presentation on the One Big Beautiful Bill, what the tax bill could mean for you. I am Chris Holcomb, the branch manager at Heritage Financial Advisors in Columbia, Maryland. If we haven't met before, I'd love to connect. Please call me at 410-975-8387 or email me chris@heritagefinancialadvisors.com. Why are we talking about this now? In May of 2025, the House passed a major tax bill, the One Big Beautiful Bill. It includes sweeping changes that may affect your retirement, income, estate, and family taxes. It was revised by the Senate, which was approved by the House, and signed into law on July 4th, 2025. This presentation provides a high-level overview of what's in the bill and how it could impact you. Our goal is to help you understand the changes and plan proactively. So what's in the bill? It makes the 2017 Tax Cuts and Jobs Act permanent. It expands deductions for families and seniors, introduces new savings accounts for children, offers temporary tax relief for workers, and cuts some federal spending. While many provisions are extensions of current law, several are new and time limited. It's important to know what is permanent and what expires. Permanent or temporary. Some provisions like the lower tax rates are permanent. Others like tip and overtime relief are temporary, expiring after 2028. We'll label these throughout so you can clearly see which provisions may impact your planning long-term versus short-term. Now let's talk about individual tax changes. The income tax rates under the Tax Cut and Jobs Act were extended permanently. The current lower brackets from 2017 will no longer expire. That prevents an automatic increase in 2026. This is a permanent change. For many clients, this preserves a favorable tax environment. However, projections still matter, especially for Roth conversions, investment income, and retirement withdrawals. The standard deductions were also increased. Joint filers' standard deduction was increased from $29,200 to $31,500, and for single filers, the increase was from $14,600 to $15,750. This again was a permanent change. This larger deduction means more income is sheltered from taxes. There's a bonus deduction for seniors over 65, an extra $6,000 per filer age 65 plus with the income limits as mentioned below. For single filers, $75,000 is the maximum income, and for joint filers, $150,000 is the maximum income to qualify for this deduction, and this is a temporary deduction. This is a meaningful break for many retirees. It could lower taxable income and possibly reduce Medicare premiums or IRMAA brackets. It expires after 2028. There's some alternative minimum tax relief as well. Now the AMT exemptions are made permanent. This simplifies tax planning and reduces AMT exposure for many middle and upper middle income households. Now let's talk about family tax benefits. The child tax credit is temporarily increased to $2,200, up from $2,000 per child. The child must have a Social Security number, and the temporary new credit expires after 2028 and then reverts back to the inflation indexed 2000. Again, a temporary credit. Families with children should plan for higher credits for the next few years, but not rely on them long term. There's also the Trump accounts for newborn babies. The federal government will deposit $1,000 into these accounts. Parents can contribute $5,000 per year on an after-tax basis, and these accounts can be used for education, job training, first-time home purchase after age 18, or anything else after age 30. Again, a temporary credit. These accounts are not tax deferred like 529. Still, they represent a modest opportunity to start early saving with some government help. What these changes can mean for you. Higher refunds for families with qualifying children, more support for newborns, but there are strict qualifications for obtaining the credit and newborn aid. Every family's tax situation is different. We'll tailor strategies based on age, income, and long-term goals. Flexibility is the key with temporary laws. Now let's talk about retiree and senior planning. How the $6,000 senior deduction works. It's available for seniors 65 plus with, for singles, income less than 75,000, and again for joint filers for income under 150,000. Phase outs occur after the thresholds. Again, this is a temporary deduction. For clients just under these thresholds, careful planning can help them qualify. Roth conversions, realized gains, and required minimum distributions must be considered. The impact on Social Security taxation and IRMA. Lower taxable income may reduce IRMA surcharges. Could also decrease Social Security taxation for some. Modeling income scenarios for retirees becomes even more crucial. These deductions could provide strategic openings, but only for a few years. Tax planning moves for retirees. Consider accelerated Roth conversions, strategic drawdowns from taxable accounts, and the timing of your required minimum distributions, or RMDs. Temporary tax benefits make now a prime opportunity for thoughtful adjustments. These moves could lower lifetime taxes and boost retirement income. Medicare, modified adjusted gross income, and marginal brackets. How deductions affect your modified adjusted gross income. First off, it lowers your taxable income. If your modified adjusted gross income goes $1 above an IRMA threshold, you might move into a higher premium bracket, impacting Medicare premiums, taxable Social Security, and net investment income. This kind of bracket sensitivity is where good planning delivers real value. $1 in income can create multiple ripple effects across tax, health, and income systems. Now let's look at estate and wealth transfer. The estate tax exemption was raised to $15 million. This increased from $13.61 million to $15 million per person. And now it's indexed for inflation going forward. This is a permanent change. This provision benefits high net worth families. Fewer states will be taxed federally, but this doesn't eliminate the need for trust or planning, especially in states with estate taxes. Who benefits and who still needs a plan? For estates, under federal law, under 15 million, little change. Over 15 million, still subject to tax. For Maryland, over 5 million, still subject to tax. Even with a higher exemption, estate strategy matters. Planning isn't just about taxes, it's about clarity, control, and passing values along with assets. Trust, gifting, and long-term implications. The annual exclusion gift in 2025 is $19,000 per person. Consider locking in lifetime giving opportunities under the current exemption rates. Now's a great time for a beneficiary review and trust tune-up. Use these temporarily generous exemptions to your advantage. Estate planning is still a shifting landscape. High exemptions may lull families into complacency. Many estate taxes have much lower thresholds. Federal rules could change again in the future. A $15 million exemption is generous, but not permanent in political terms. Many clients still need a plan, especially in states with estate or inheritance taxes. Charitable giving and legacy planning. Donor-advised funds can lock in current deduction rules. Charitable remainder trusts, CRTs, may help reduce income and estate tax. Giving strategies need to align taxes with legacy goals. Strategic philanthropy lets clients control their charitable impact while minimizing taxes, especially important during periods of policy flux. SALT deduction, tips, overtime, and other deductions. The SALT deduction was raised to $40,000. The state and local deduction cap raised from $10,000 to $40,000. This applies to incomes under $500,000. It phases out gradually above that, and this is a temporary deduction. This is one of the most contested provisions of the bill. It offers major relief to residents in high tax states. Tips and overtime pay, temporarily tax-free. Tips and overtime wages exempt from federal taxes applies only from 2025 through 2028, again a temporary deduction. This provision could provide meaningful short-term savings for service workers. Its short lifespan makes timing critical. Businesses and employees should both be aware of this. Auto loan interest deduction, only on American-made vehicles. Interest on loans for U.S.-based vehicles becomes deductible. Applies to vehicles purchased in 2025 through 2028. Deduction would phase out for individuals making over $100,000. Again, a temporary deduction. This fulfills a campaign promise but has limited impact for many clients. Still worth mentioning if a vehicle purchase is on the horizon. Final client guidance. What can you do now? Review your tax projection for 2025 and beyond. Evaluate deductions, credits, and estate plans. Discuss with your advisor before year end. The most proactive clients tend to achieve the best outcomes. We'll run side-by-side scenarios and help you stay ahead of the curve. Stay informed, stay proactive. Tax law has changed. Proactive planning now avoids scrambling later. Let's keep revisiting your strategy to ensure protection. Our goal is to stay one step ahead. Your strategy should evolve with the law to keep you optimized, protected, and confident. Let's review your plan together. Are you taking full advantage of your current opportunities? Are you protected against future risk? Let's schedule a time to review. The goal is to preserve your wealth, reduce taxes, and align your plan with your life. Let's talk. Again, Chris Holcomb, Branch Manager at Heritage Financial Advisors. Give me a call at 410-975-8387 or send me an email, chris@heritagefinancialadvisors.com. Thanks for your time and have a great day.